The so so what we did is we just started talking about the products that North American has. The we got everybody in here. 1, 2, 3, 4, 5, 6. Mark, make sure I got enough of these. If we don't, we go grab some more. The and when we look at the builder IUL, we all have to decide on what type of products and what marketplace we're going to work at. And we got to match the client with the carrier with the exact product of what that client is actually looking forward to buying today. Well, this morning what our goal was is to sort of tell you a little bit about North American and get you familiar with the company and make you feel comfortable about writing business with this one particular carrier. As we all know, no one company can just solve one person's needs because there's a lot of different things. Today, with the insurance market, we'll go into a house and somebody may need a health insurance policy. They may look at long-term care. They may look at buying an annuity. Those of us that work the senior market and those that actually work the Med Advantage and the Med Sup market, a lot of them are familiar with, they got to have an appointment and they can only go in if somebody's over 65, and you only can sell them one product at one time, and you have to actually schedule an appointment to come back and sell something different. So that doesn't mean it's bad. It just means that's the way some of the insurance departments have chosen to help us to help the client. Sometimes it feels like a hindrance, but if you think about it, if you go into a store and you're going to buy clothes, and you go into that store and you want to buy a pair of pants, the most important thing is that you don't want a guy to try to sell you a shirt or a girl to sell you a shirt. You know, you want to buy what you want to buy. So I tell people, in my 37 years of experience selling insurance, they know what you're coming there to talk about, so you try to stay focused on what you're trying to market and trying to get them to buy. And then once you can go into that market and start getting that client to see that you're there to help them, then, you know, I always say sell them what they want first, and then you can come back and sell them what you want to sell them. And so as we start looking at these different types of products, when we look at the index products with North American, they got the Builder IUL, they got the Guaranteed Builder UL, they got the Rapid Builder UL, and they got the Survivorship UL. When we look at the guaranteed products, they got the Custom Guarantee, the Custom Term UL, and the Custom Growth. And then we got the selection of the term products that we actually market and sell. So when we look at these products, one of the things that makes it neat and why I like North American, not only do they have good credentials, they have an A+, AAA rated company, but they also have they're A+, I don't know why I said triple net, but yeah, I reckon I'm thinking they're renting. But they're an A+ company, but when you look at the three types of products that we've got our permanent type products, which are regular ULs, we got our index products, and we got our term products that they're actually selling. When we can go down to 25,000, now we can almost help any individual, because now we can go to that lower amount. And those of you that like this, I'll print this for you so that you don't have to take a whole lot of notes, but I'll just give this to you so you can take it home with you today. When you look at the zero net loans, that's important. So when we put our money in, we actually can pull this money out. When the company pays the interest and we get credited the same amount of interest, we get a 0% loan. So the only thing that I always tell you is important about a loan is that if you do this loan, you want to make sure that the policy doesn't lapse. Because if you borrow more money out of the policy than what you put in, it will create a taxable event. And that term is called phantom income. For an example, if you put $100,000 in a policy and it grows to $200,000 or $300,000 and you pull out $25,000 for 10 years, you pulled out $250,000 out of that policy. Now, when you die, that loan is paid off, so you don't have to pay any taxes or anything. But if you cash that policy in, then the company's gonna generate a 1099-R, and so all of a sudden, you're gonna see that they pulled this money out, and you're gonna have to pay tax on something that you didn't ever think you were gonna have to pay tax on. So a lot of times, when I talk to people about insurance that they got and they call, they wanna cancel it, I always wanna look at what their cost basis is in that policy and how much cash that they built up and how much they pulled out to make sure they haven't pulled out more than what they put in. Also the bonus that we have with North American is a 75% bonus that comes into the 11th year. There are no funds required in the fixed account, so you don't have to mix it. We do have the accelerated benefits inside the policy, and I've got something turned on that's erasing.
What's that?
Yeah. It didn't like, I don't know why I did that. So now I fixed it.
Hey, Terry,
Yes, sir.
on the accelerated death benefit endorsement, I know it says benefits for chronic and terminal, but what about the critical illness on there?
Yes, the critical illness is there also. They've got a good marketing guide that those of you on the telephone don't have it right this second. But when we look at but the most important thing to a lot of people is the terminal illness and the illness where we have the 2 ADLs, where that you're actually able to go in, and if somebody has 2 of the assisted daily living, they don't have to worry about going into a nursing facility. They actually can use their policy that they've got to come in and to help them with that actual piece. The other thing that we can look at the markets as we try to start building different markets, we can use life insurance to supplement our retirement income. So for an example, today a lot of us are really struggling to save money. And so we're trying to balance, how do we have enough insurance, how do we put money in our retirement, and then how do we pay all our bills? And so when we look at these IULs, the North American product has a 3% rate guarantee. Not only does it have a 3% rate guarantee, but it also has 100% of the market, and let's say that up to 11%. And so let's use that 11%, but let's just say we showed 7%. What I try to do is I look at the last 15 years or the last 10 years of what the S&P index paid, and then I'll show it maybe 200 basis points less. So if you're showing 7, show 5, and then it'll always show the 3% guarantee. So if you look at a CD today, we talked to a client the other day that had $1 million in his CD, and he was getting less than 1% interest on his money. So if you figure 1% on $1 million, you're getting $10,000. So think about it. A person worked their whole life, saved $1 million, and they're scared to spend their principal, and so they're pulling out $10,000 a year or $800 a month. That's pretty tough. And see, before, some of us are of age that we remember this, when the interest rates were 6 and 7 and 8%, and people were getting 6, 7, 8%. Well, see, that same person would be able to pull out $80,000 a year in their retirement, and they're excited about that, because now I've got $80,000, plus I got my Social Security, and I'm not spending my principal. How many people do we talk to today that think about that? The other thing that we look about is that when we use this IUL market, we got the potential for high cash and high flexibility and control. So sometimes we can skip a payment. Sometimes we can add some extra payments. We got to be real careful, though, if we're really working on having a guaranteed benefit product. For an example, if you buy the policy and it has a guaranteed rider, you have to make sure that you pay your premium on time. I'll give you a perfect example. If a person does a 1035, and 1035 exchange can help build cash a lot quicker because we can move from one policy to another policy. So for an example, in a 1035 exchange, we could look at some products out there, like I bought an old policy from Kentucky Central, that today that policy is paying 2%. It's an old policy. The company is never going to change the interest rate. They have no benefit to give me a higher interest rate because it's an older policy. They're gonna make the new policies more attractive than they do the older policies. And that's not cutting down any insurance company, it's just the fact. So when we look at it, and we look at that 1035 exchange, and we pull the dollars that we've got to come over, and we look at, okay, now we're gonna try to save money for college funding. Well, see, when we look at college funding, we're all smart enough in here to know that we can't put enough money in a life insurance policy to pay our kids' way to college. But I tell you what, grandparents could actually buy a policy and put dollars in there to help their grandkid. Plus, they can put a death benefit on there that if something happens to them, that it'll go to their grandkid. And see, one of the things that I did as a grandparent, I got a 5-year-old grandbaby. I bought a little $230,000 term policy, made her the beneficiary. And you don't really make a minor a beneficiary. You have actually set it up and put it into a little trust, and that trust will actually pay for that grandkid to go to college. And so at least you've got a little thing set. And when you look at it, term insurance is not that expensive today. When we look at the features on that guaranteed builder IUL, the minimum benefit on it is $50,000 up to age 59, and then is $25,000 to 60 to 85. That benefit has really helped us out a lot. I was helping an agent the other day that went to this gentleman. He was 81 years of age. His policy was lapsing. He went to North American and paid $173 a month for $25,000. Now, if he would have bought a final expense policy, which we'll talk about in a few minutes, he would have paid a lot more money for a less benefit. He'd have probably maybe got $10,000 to $12,000. Now, the reason why we did that and asked the health questions was so that he could get a better benefit. So when we start looking at helping people, when we go through the application and we hit a yes, for an example, if the yes was, I've got high blood pressure, and then I got COPD, and you say, oh Lord, well see, COPD on the regular company is automatic decline. You're not going to get anything. But we have 2 or 3 final expense companies that don't ask that question. We got one final expense company that don't ask any questions on diabetes. So what happens is, as you get trained and you start understanding those things, you'll be able to figure it out real quick. For an example, I talked to a gentleman the other day that was 6'1", weighed 253 pounds. Well, that is not a standard rate with North American. So if you send that in, he's going to be rated. Okay, but if you sent that same product to F&G or Foresters, that's a standard rate at 273, 20 pounds heavier than what he is. Now, is that premium cheaper than the North American? No, but it doesn't matter. It's almost like getting all of us in a car today, and I'm going to take y'all over here and show you $1 million house over here in Wakefield for sale. And then you tell me your budget's $150,000. Well, I'll tell you what, we messed up the whole day, because now we've gone over and looked at the bedrooms in the $1 million houses, and now we go back and look at the ones that are $150,000, and we think, daggone, this is a closet. You know what I'm saying? So the same thing with insurance. People are where they're at. Their health, their wealth, you know, and I use this saying, I tell people this all the time. People spend their wealth and give up their health. They spend all their life till they get to older ages, and they don't take care of themselves, and then they wake up one day and they got high blood pressure, they got diabetes, they got some other issues. And then they'll take the rest of their life and their money to buy back their health. And they buy it in the form of going to the doctor, paying deductibles, paying prescriptions, that's exactly right, and then trying to figure out, you know, even to this day, we see people cashing their houses in, and I call it cashing in because they go out and they'll do a reverse mortgage to kick cash in to help them to make their living to the end. And so when we look at it, the average retirement plan in America has $25,000 in it. Yes, sir. So when you think about it, that's not a lot of money for retirement purposes. And so when we look at the estate planning aspect of this, we've talked about the retirement, the estate planning part is to pay the taxes. Well, today, if you look at it, it's a little over $5 million a person. So when we look at estate planning, we have taken almost everybody out of the market. Because a husband can leave an unlimited amount to his wife. She has to pay no tax. When she dies, she can leave a certain amount, and let's say it's $5 million a day. Well, almost everybody we're going to talk to is not going to have a problem with estate tax. See, we can talk about it for a young person that may be making $200,000 or $300,000, and you can tell them, hey, look, you're going to have a problem down the road if you start accumulating and you're doing all these things. Because we meet people, I've met young people that had a lot of money in their account. But see, the hard part ain't getting the money. The hard part is hanging on to the money. Because see, when we do things, you know, it's just like buying this building and doing all the stuff there. Well, when you look at how you go out and buy an asset and you think it's going to return a certain amount of money, there's still market things that we can't change. And so if we could, we would do those things, but we don't have that opportunity. When you look at the Rapid Builder, the Rapid Builder has a waiver of surrender charge option. And what that option does, it makes the cash value on a policy be 100%, or roughly 98% to 100% of what the cash that's in there would be. Now, why would that be a benefit? Well, sometimes you run into business owners, and let's say that they keep $100,000 in a CD, and that CD is paying them 1 or 2%. Well, we could take that same $100,000, roll it over here, put it into an insurance policy that still had $100,000 cash. And what that means is that there's no hit to their balance sheet. So when they send their balance sheet to the bank and it shows that they got capital of $100,000, they still have $100,000 in this policy. The only danger that we have as agents when we sell that policy is that if they cancel it in the first 3 years, we get a charge back on our commission. The first year is 100%, the second year is 75%, and then it's 50% on a lot of contracts. So we want to be real careful on that. Same thing when we do retirement planning for annuities and things. Now, when we look at the interest rate bonus on this Rapid Builder product, it's 0.5% in the 16 years. And so, you know, you do have early access to cash surrender value, and you have early cash value growth potential. And what we mean by growth potential is that it's building up the surrender value a lot quicker. And so why would that be important? Because some of these policies, you know, when you get out to the 10th year, have a lot more cash, and this one would have a lot more cash in 3, 4, 5, 6, 7 years. And that might be important for somebody who was thinking about college or thinking about paying some loan off. One of the things that each one of us need to get a real good glimpse on is what we call mortgage acceleration. So when we look at doing term insurance or planning, all of us know today if we paid our house off in 15 years, we'd be a lot better off than paying it for 30 years. But most of us take the 30-year mortgage, me included, because I was over there budgeting for a payment. You know, it's just like when I buy a car, I'm the worst person in the world. I really don't focus on the interest rate as much as I do what the payment is. You know, because if they tell me, if I'm paying $500 a month for a car and I can trade this car in and I pay $500, our mind just gravitates to say, okay, I'm paying $500, I got a new car paying $500. We forgot we just added 3 or 4 or 5 more years on to what we just had. And we almost had the thing paid off. That's America. I can't explain it. You know, people think that way. And so when we look at how we budget and how we try to help each other, we got to look at what these products do. When you look at those business owners, you know, executive bonus, and see some of these things are sexy that you talk about. You know, I'll give you a question. When I go out to work with a business client, the one thing that I want to do is, you know, really focus on the market that you're really good at And those of us in this room today, there's 10 plus of us here, plus on the telephone, the thing that we want to focus on is really what market are we comfortable with. See, if we're not going to go out and talk to people that make $1 million a year and try to sell them insurance. Now, if we can get in there, fine, we'll bring somebody with us and try to get them to help us to do that. That's, for example, you guys with Ron would go in there to help you with that person. Well, you feel real comfortable walking in there with Ron to go out and talk to somebody. You might feel comfortable with me going in there talking to somebody. But when we look at the business owner, don't jump out and try to start selling businesses to begin with, because you'll starve to death. And I don't mean that ugly, but it's so tough because you got to get in there and you got to build a rapport. And this morning at 8:15, I was talking to a gentleman that I've been working on for 5 months, and it was $1 million case on Blue Cross Blue Shield for their health insurance. And they paid $1,200,000 last year in premiums and charges. I showed them how they could save and do it for $800,000. And one of the owners is 80 years old, and he says, but I still want to pay everybody's premium, and I don't want to subject them to a policy. I want to stay self-insured. You go, oh gosh, and see, it just drives you crazy. They said, well, we'll wait till December. Well, I'll still be here in December, but I tell you what, we needed to pay a mortgage or pay this bill or whatever. We're all the same way. You know what I'm saying? We got to be real careful because we can't let them see the fear in our eyes, or that we got to make a sale to pay our mortgage, because see, people can sense that. You know what I'm saying? They can feel it. And I always make a joke. I said they can almost smell it when you're in the interview. You get in there and you start pushing real hard, and they start looking at it. So when we look at business owners, what we would do, and the guys that are down there with Earl, what you would do on the business owner is that once you get a business owner, there's only 2 or 3 hot buttons. There's what we call where we can, if you're talking to the owner, he might want an executive bonus out to somebody. We also got a non-qualified deferred compensation program. And what that is, that's just a fancy word for buying life insurance that you can't deduct and pulling it out of the person's paycheck. But it sounds a little sexier, you know what I'm saying? So, hey, look, what if we could just take $100 out of your check a month? Or that owner might say, hey, look, I'm going to make a Keyman policy and put $100 a month into a plan for you. And see what that does, that gives you a little bit of death benefit, but it also tells them, hey, look, I'm a good employee and they're trying to do some things to help me. The other thing is a buy-sell agreement. When you talk to people and they own a business together, you don't need to know how to go sell everything. You just need to know how to disturb somebody to ask a question to get an interview. So what happens is that when we go out and see a business owner and they say, yes, hey, what do y'all do here? And he says, well, we sell, we do heating and air conditioning. And so we service it and we put new units in. Oh man, that's great. Did you start that company by yourself? And so let's say me and Ron were partners. I would say, no, me and Ron are partners. Or me, Ron, and Earl are partners. There's 3 of us. And you say, well, that's interesting. How long y'all been in business together? Oh, we've been together for 15 years. Have y'all ever thought about, did y'all set up a buy-sell agreement? Because you don't want to get too deep in it, but you can just ask them, hey, no, we never did anything. Y'all ought to think about that. I'd love to be able to talk to you sometime about that. And then carry your subject on further and just talk about something else. Because see, then, now you plan to see. The next time you see that person, you could bring that up again. Or you could pick up the phone, or you could do what I would tell you to do, and we'll show that in just a minute, where we would go actually online and print a little one-pager on buy-sell agreements, and then take a sticky note. Don't write them a letter or her letter. Take a little sticky note and say, Fred, I was thinking about you, or Earl, I was thinking about you, and fold it up, send it in a little envelope. And so then now, those of you that kept your book, the book that I gave you so you can write down your people's names, so then you write down that person's name and you put it in there, but you don't have one? I'll get you one. You didn't get one? You didn't get one either? Okay.
Hey, Terry.
Yes, sir.
I've had people in years past, and I know you have too, and I'm just saying this for everybody's benefit, that have told me, well, I get along real well with my partner's wife, and, I'm sure we'd get along well if something happened, I don't need a buy-sell agreement, and so I always say, well, that's great, but would you get along well with your ex-partner's ex-wife's new husband?
Yeah.
How would you get along well with him? Because if your partner dies and you're in business with his wife, that's one thing. But when she gets married, you may not get along with that guy that she marries, and all of a sudden he's an equal partner with you.
Yeah, I agree. And, some of the things that, everybody has to build their own personality in here. And see, when you look at this little page here, if you'll turn over to July, because we're almost there, what we were talking about, and this was something that the rest of us had already went by, this is where we start putting our list together. So see, then you can carry this everywhere you go. So when somebody talks to you, oh gosh, let me write that name down. I was at Jubilee Church yesterday in Durham, helping the pastor there on a couple of things. Well, see, all of a sudden, he might bring up a person's name that's in business or somebody that's, that you could actually go out and help and go out there and see. Well, see, when we're in a fishing expedition, it's one thing. But like Earl said, when you're sitting there in front of the client, you got an opportunity sometimes to say some things that you normally wouldn't be able to say. The other thing I talk about, and it's no big deal, it's called wealth transfer. And so what happens is when they're in retirement, and they're at a retirement age, that's one of the things that I'll come back and talk to them about wealth transfer, where I go in and say, hey, how are you going to pass your estate on to your children? Or how are you going to do this? I was dealing with a principal the other day, 67 years of age, came in here, and that was what his concern was. Well, see, those of you that are children in here, all of it, our parents never thought we knew anything. I don't mean that ugly, but you're still the kid, you know what I'm saying? So when parents are going to leave you something, a lot of times they won't tell you what they're going to leave you because they're scared you'll start planning on it. And see, the other day I met with a lady here in town with another agent, and she had just retired from the bank, and her concern was, is she says, hey, look, I want to give each one of my grandchildren $10,000 of my life insurance. She said, I told my daughter about it. My daughter said, don't do that. You give it to me. I'm the one that's taking care of the grandkids. I'm the one that's going to look after them, so give me that money. So she came back to me and she said, I was so mad, I didn't know what to say. And I said, don't be hard on your kids because you got to think they're struggling just like everybody else. So think about it. If you're going to give, there's 3 kids in that family, you're going to give those kids $30,000 and they don't know what they're going to get, they're thinking, if you're going to give them kids $30,000, you better give that $30,000 to me. I can use this to pay this, this, and this. And I said, now you understand why people, when they set their wheels up and stuff, a lot of times people never even know what they were going to give to somebody. Okay, so let's move a little bit forward. Okay, when you look at the survivorship guaranteed index of UL, see, this is a $200,000 face amount. And the second death band is at $1,000. It has a 0.5% bonus in the 11th through the 20th year, and it has a 75 basis points after the 21st year, and it has that surrender benefit. I'll tell you where this benefit works good. If you're trying to leave money to your kids and you wanted to buy a policy and you can afford to buy a minimum of $200,000, the premium is about half of what $200,000 on one person would be. So what happens is that you buy the policy and they average both of your age and your benefit, and then it pays on the second death. It don't pay on the first death. Because remember what happens. The wife gets everything free the first death. The second death is when you pay all the taxes. I had a gentleman in Durham that we were helping out with North American, and his CPA had figured out that they're going to have to pay about $1 million in taxes when they die. So a regular policy would have cost him $39,000 a year, okay? And this guy actually owns a little used car lot, and he's done real well, you know what I'm saying? He's made a lot of money, and he has a few $1 million in the bank and retirement plan, and he's got some rental houses, got a beach place, and all the other stuff. Well, see, if you're a kid and your family members have got things like that, it's a benefit to get them to talk to you, to tell you what their plan is. Not to change their mind, but when they unload this in your lap, you would like to really know what's going on. And see, so the thing is that it's just like my wife. She's real blunt on some things. Like one of the things she said, you know, I got a lot of irons in the fire with this building and other buildings, you know, doing other stuff. And she always says to me, she says, man, if anything ever happens to you, don't expect me to pay all that stuff, because you better have that thing fixed out right, because I ain't coming in there and taking what money's left to me to go pay bills with. You know what I'm saying? I'm going to use it to live on. And that's fine. You know what I'm saying? And that's how you need to speak to your wife. That's how business owners need to speak to each other. And see, when we look at this last to die option, that's a way that we can leave money to the kids, and the kids look at it and see the premium. This gentleman is paying $10,128 instead of $39,000. And so Michael said to me, he says, you know, he says, I get mad every time I write this check. And I said, well, look, don't get mad. I said, because the beneficiaries are your 3 kids. And they're going to turn around and pay all the taxes, and everything that you owe, they're going to get tax-free. He says, well, how do you know that they're going to care about it? Here's an example he used yesterday. He said, my family spent $700,000 on a lake house. The mama and daddy died. The 2 kids that got the lake house sold it for $375,000 cash. Now, the problem that he had with it wasn't that they sold it. He felt that they didn't care what they got for it. And, you know, where this particular place was, a lot cost $200. The boathouse cost $50. The golf cart that they left cost $10. And the pontoon boat that they cost $20,000-$30,000. And then the ski boat that he had there cost that. Without even a house that had it. They didn't even get the furniture from the mom. They didn't even get the mom's crystal. They didn't get the thing. He said all they cared about was that money. Well, it wasn't that problem. The problem was that they never worked it out. They just saw, oh, look, here's our offer. This is the first offer we got. We might not be able to sell this thing because the market's not really good in that kind of business. So that they sold it off. And me and him had that conversation. I said, see, here's what would have happened. See, you could have set that up in a trust for your kids and your grandkids, and you could have said, hey, look, I'm going to give you $350,000 worth of insurance, and here, I want y'all to keep the family going. I want to keep y'all going to the lake place and all this stuff, and I got a little bit of money set up here to pay the taxes and stuff for 4, 5, 6 years. And then after the kids get out of school and they move on, let them buy it, or they can take on it and they can do the benefits on it. So at least they got an opportunity. But see, if you only left somebody one piece of property for a benefit, my grandmama died and left me 9 acres of land in Newton Grove. Now, what do I want 9 acres of land in Newton Grove, North Carolina for? Now, but the thing is that it's right beside where my aunt lives. So my aunt would be mad if I went and sold that 9 acres of land. But the point is that if I leave that 9 acres to my kids, what do you think they're going to think? They ain't thought nothing about it. And they ain't never even been down there and looked at it. You know what I'm saying? See, so when you think about it, they go, what's this for? And then somebody calls them that lives on the other side of her and says, hey, look, you got that 9 acres of land. I'll give you 4,000 acres. That's $36,000. They go, oh, man, $36,000. Yeah, when can we close? You know, and they might go buy a car with it or something. You know what I'm saying? Or ain't no telling. Flat screen TV. I don't know. But, you know, I'm not picking on them. I'm just saying, you know, as we look at different things, people think different ways. When we look at the estate planning or the family business or how we're going to dispose of it, see, a lot of people haven't thought those things through. And see, that's why we want to start educating them. And see, the thing is that one of the strongest things I've ever done to people when I'm sitting in a closing interview, I always ask them, I say, hey, look, I ask the wife a lot of times when I'm sitting there, and I say, what keeps you up at night? What do you really worry about from your financial stuff? You know, and some of them will say, well, I worry about paying the house off. And see, in this economy, the way it is today, think about how many people, both the husband and the wife, have to work to have a house paid for. Think about, I'll use my daughter for example. She looked at putting, our grandbaby in childcare when it was born. And so all of a sudden, they want for a newborn $1,200–1,300. Okay, if the person's making $3,000, they're clearing 27, they pull out $1,300 to pay for childcare, then they pull out their gas, then they pull out paying for going to eat lunch 2 or 3 times a week, and buying their food and all the other stuff, pay somebody to clean up their house. All of a sudden, it don't look as attractive for the spouse to work. I've had that happen here in my business. Where I've had a young lady to work, and then they have a baby, and they have a second baby, and they go, man, it's better for me to just stay home and not put them in childcare and bond with my children, and I can get a part-time job working at Walmart or something. You know, I mean, I'm not making a joke, but it ain't really funny, because I've got one couple right now that I got insured, that the wife works Friday, Saturday, and Sunday at the Walmart distribution center in Fayetteville, and her husband works the whole week. So she watches the kids, and so on Friday, Saturday, and Sunday, she goes in and does that work and gets paid for 40 hours. You know what I'm saying? A lot of nurses do that. I don't know if y'all know that. But there's a nursing program here at Wake Med and other places where they'll pay them that. So when we look at using life insurance to supplement your retirement, we can actually show how that actually works. The custom guarantee, this is a good product, and there's a good rider right now with North American on this custom guarantee. If they buy the custom guarantee now, they're going to be able to convert it to the Builder IUL later with no health questions, and just sign a form and transfer it. So if you show somebody the other policy that builds cash, but they just can't quite get there, you could actually sell them this product, and just like all our products, if they get the age of 100, there's no premium beyond 100. And this is what I was talking about, that guaranteed exchange privilege. There's a guaranteed exchange privilege where we can do it. We got a 2-year rolling target. The reason why that's important is that because a lot of times when we sell this premium, the minimum is less than what the target is. We just saw a case this past week where a gentleman bought $200,000 and the premium was $4,000 he paid, but his target was 6. So what that means is you get your commission this whole year, and then next year you get paid on another $2,000. So instead of renewals, you get the whole target. And see, that helps you in bringing, some other dollars in. When you look at the guaranteed death benefit, that guaranteed death benefit goes up to age 120. If you look at companies like Lincoln Financial, I'm not picking on them because we write with Lincoln Financial, but their guarantee goes to 95, and that's it. You can't get it past 95. Why would y'all think that they changed that and not let that rider go past 95? Statistics show that. That's one reason. What is another reason? Payments are lower. The main reason is the insurance company has to put up a reserve to go to 120. If they put the reserve up to 95, they don't have to put as much cash in there. That's why they actually go out and start looking at it. That's the primary reason. And the secondary reason is what she said. People think they ain't going to live to be 95 anyway. You know what I'm saying? So I got one client right now, I won't say his name, but, he's 94 years of age. We bought a policy 20 years ago. We had this conversation. Man, just make sure it goes to 95. I ain't going to worry about it because I won't be here at 95. He's 94 and he's living off of Strickland Road in that assisted living. And every year when I sat down there, he goes, man, I'm going to have to put some more money in. And so the thing is that this year I got to go to him and he's going to have to put $15,000 in 4 policies. So he's going to have to pay $60,000 to go another year. And I'm going to tell you, if y'all saw him right now, he's not going to die next year. You know what I'm saying? I hope he don't anyway. You know what I'm saying? And so I got to go back to the trough again. And so he let his kids own the policy, which is a trust that owns it, and his kids are the beneficiary of the trust. So those kids had to go look at it and say, we got 2 choices. He's got $2 million worth of life insurance with me, or he's got $800,000 of cash value. So he can either take, the kids can take $800,000, or pay $60,000 and get $2 million when he dies. So what do you think they're gonna do? They're gonna pay the $60,000, you know what I'm saying? And so they're gonna pay it next year, and they're gonna pay it next year, and they're gonna pay it the next year. You know, so the thing is that now, you know, he laughed at me the other day and he said, well, what do you think? I said, well, the only choice we got is we can take you out behind the building and shoot you. And he said, well, that's not a good answer. And so his kids say, well, we'll just pay the $60,000. Now, the other choice that he could do is I lowered the face amount. I want y'all to know this. I lowered the face amount on each one of those policies from 500 to 300. Okay, guess how many more years it went without paying any more money? 1 year and 2 months. Because you got to think about it. He's 94 years old, and the cost of insurance, what do you think the cost of insurance is? It's high. I don't want to beat up on Northwestern Mutual, but one of my clients had bought a policy, and he had it paying up to 95, and so I asked Northwestern Mutual to go back and tell me at the guaranteed rate, what would he have to pay 96, 97, 98, 99, and 100? Well, the first year premium was $200,000 for 96. Now, we can argue about, well, 200 ain't going to be worth what it is today. So we can have that argument. And we can say, yeah, but the dividend showing today is 6%, and you know the dividend is going to be higher than that 20 years from now. No, we don't know that. We're sitting here today, and you know, I've been trying to get my building refinanced and hope this is going to happen in the next couple of days. They went yesterday to do it, and there was one thing we had to fix. But see, they were looking at dropping our rate from 6.25 to 4.69. Well, that's a lot of difference in money payment. And see, so what ends up happening is that we're starting to see, every one of us in here ought to have refinanced our house by now. We got a home. Because if we can get 3 and 3.5% interest on our mortgage, man, we should be paying 3 or 3.5%. And so when we look at these custom guaranteed products, I'm going to click over here to the custom term. The custom term is a lower pot product. We sell maybe 1% of those on UL. Because what happens is the custom guaranteed UL goes to age 100, but you'll have a lot of people that'll see what that premium is and they'll look at the 30-year term, and if they're 50 years old, they go, hey man, this 30-year term will get me to 80. I don't really care. You know what I'm saying? And so if I get to 80, I'm all right. And see, it's all right till you get to 80. And see, that's all right. And see, how many of you ever listened to Dave Ramsey? When you listen to Dave Ramsey, I like Dave Ramsey as a person. I like his beliefs. I like what he tells people. But see, the thing is that if we do planning with people and we use the Dave Ramsey approach, you can't do part of what he says. You got to do all of what he says. I'll give you a perfect example. How many of you in here have a 15-year mortgage? Nobody. Okay, well, wait a minute. So you're listening to Dave Ramsey, and you're over there planning on what he's doing, and now you got a 30-year mortgage? He told you to get a 15-year mortgage, and then you can buy a 20 or 30-year term, and you won't need insurance. But those of us that got a 30-year mortgage, myself, I'm 57 years of age. Now, I bought my house 10 years ago. When will my house be paid for if I got a 30-year mortgage? 20 years. How old will I be? It'll be a little tough on me, ain't it? To keep paying my payment until I'm 77 years of age. Now, how did I as a person justify that? My justification was, okay, when my kids get out of school, when they're out now, I'm going to sell my house, I'm going to take the equity, I'm going to downsize and get a smaller house that just me and my wife can take care of and look after, because we don't need all the stuff that we had when we had our kids and our grandkids and stuff. Okay, that was a good idea. What's the problem with that philosophy today? Houses ain't selling as fast. Did you realize there's over 1,000 houses in this zip code for sale right now? Now, that don't mean it's bad, But if the market is, if there's only 100 people coming in, it's bad. If you're one of those 1,000. Now, there's people selling houses every day because somebody's buying a house and they like this one better than that one. If you look at this building, when I built this building 12 years ago, my idea was to sell it to an investor group when I got up here and my kids got out of school, take my equity and go back and do that. Well, see, in this corridor right here on Capitol Boulevard, would y'all care to guess how many square feet is out here listed for sale? Rent, 600,000. 600,000 square feet is empty right now. Now see, I'm not doing that to educate you, but I am doing it to try to tell you, when you look at the marketplace, the market can change real quick, and see, that dictates what you can go out and do and what you can buy. And see, the thing that's nice about this with our life insurance, it's constant. Even if we buy the low-term UL, and when we say juveniles in here, the thing I always talk about that, we're going to build a little bit of cash, but not a lot, but we can sell it on children and things like that and get them a cheaper rate for the rest of their life, so we can do that. Parents aren't looking at building a whole lot of cash. And remember, when we sell insurance to one of our children, we only can sell 50% of what we own. So if we own $1 million, we could sell our children and put 500,000 on them. And see, no company wants you to go have 100 on you and put 250 on your kids, because it scares them. They go, wait a minute, why are you putting 250,000 on your kid and you ain't got but 100? So it's sort of a scary thing. And see, when we look at the death benefit and the cash value, and see, we actually can roll this product over down the road. The custom growth guarantee is not really more of a guarantee, but it's more of an interest rate and a cash accumulation product. Because some people want to stuff as much cash into a policy, and they don't worry about the investment options. Remember, when we do index products, the most important thing to us is building cash and building money to build up so that we can have some money at retirement. We worry about the guarantees, but see, the guarantees are so far off, we got to worry about getting there. It's just like today. It really don't matter what the market is in a building or whatever, you still got to pay the payment. Make sense? So it don't really matter what it is, you're where you're at. And see, today, when we look at it, the insurance companies now are trying to track what this growth is. And so the other thing that we look at, all of us can understand term insurance, and I want to spend the rest of the time talking about term insurance and pull up these final expense products so I can talk to you a little bit about the mortgage planning and the term planning. Well, when you look at the multiple policies, you got what we call 10-year, 15-year, 20-year, and 30-year. One of the things that we have done as a group is what we call staggering policies. And I have done a lot of these because people don't think about it. When I was growing up and my children were 6 years apart, so when one was 5, 15 years later, the 6 years, 5 and 6 years is 11. So I had one going to college in 7 years. I had one going to college in 13 years. So we could actually buy a term policy for 10 years or 15 years and keep it for $75,000. Then I could buy another term policy for 20 years for $75,000. And at the end of the 15 years, that premium would drop off. And so instead of buying one 20-year policy for $150,000, you still getting that? I can buy $150,000, one for 10 years, one for 15, one for 20. So then what happens is that all of us today, I'm 57, so at 67 I might lose 50,000 of coverage, but I still got 100. But see, now while I'm working, I still can pay for 75, 75, 75. So let's say we had 300,000, make it real easy for our math. I could have it where 100,000 would drop off, or I could have sold myself 50 or 75,000, I had it drop off, and then I went on, and then on my 20th year, so if I was 77, I bought a 20-year, I'll be 77, so I can say I got a $100,000 policy. When we look at North American, we can convert that policy all the way up to age 75. The problem that we have with that, everybody likes that idea. They just don't like the idea of paying the premium. I don't have problems with people saying they need insurance and wanting to pay for it. I met with a gentleman the other day, and I like using stories, y'all, sort of get your creative juices thinking. I met with a guy who was a policeman here in Raleigh. He's actually, in charge of one of these units out here. And, you know, his premium was $75. And I said, man, look, for $95, we can go from a 20-year term to a 30-year. He said, I can't afford the $20. I said, no, I ain't being ugly or nothing, but in your budget, you can't find $20. He said, Terry, I can't do it. He said, I'm helping my daughter, I'm helping my grandbaby, the father's not in the picture anymore. He said, every extra dime I got goes to that. He says, I've got the coverage, and I'll just use it for 20 years. That'll still get me up to 70 years of age, and I won't worry about it. And I said, okay, when you retire from the state, what's going to happen? And I want y'all to remember this, because you're going to have people that y'all run into that this is going to benefit from. This man's going to retire at 62 years of age, and so he is 57 years of age, so in 5 years he's going to retire. His retirement benefit is $2,000 a month with the state of North Carolina. That's what his retirement check's going to be, $2,000. Okay, I said, well, look, I want to do a little exercise with everybody on the phone and everybody sitting here. You're sitting there and you're going to retire, and your wife forces you to bring her with you, or your husband. So now you're sitting there in front of the person and you're talking about your retirement benefits, and I'm going to be the counselor and I'm going to do both parts. So the guy's name happens to be George, and so I'm going to pick on George. And so, George, you and your wife, when you retire, your benefit is going to be $2,000. You're getting $1,800 from Social Security. You're going to get $2,000 here, so you get $3,800. Now, George, if you take this option for $2,000 and you work for 2 months and you die, guess how much your wife gets for that $2,000? Nothing. It's called a life option. Now, but don't fret. If you want to give her life insurance, and you want her to, if you want to give her a retirement check, you can take $1,500, and if you take $1,500, she'll get $750. And so now, picture yourself, you're sitting there with your wife or your husband. Don't picture yourself by yourself, because to take that option, you got to get your wife to sign the form. If you've been married 10 years or longer, you got to get them to sign that form that says it's all right to take the life option, and she knows that if you die, she ain't going to get nothing. How many of us are going to be able to get that form signed? If I even ask my wife to sign it, I'm dead. I won't be here for the next Thursday meeting. It'll be over. And I might be singing in a high pitch when I'm talking. So when I look at this, what is his option? Take the 15. Well, he has a second option, and we want y'all to know this. This is why we're here to help. Guess what it would cost him to buy a $300,000 life insurance policy from North America? $375 today, a year, per month. Okay, hey, look, he was going to give up $500 to get $750 a month for his wife. And if his wife died first, he's gave that $500 for the rest of his life. He gets nothing. So he's going to lose $6,000. So the thing is that what do you think he said? Oh, man, I got to start planning. I said, here's what we're going to do. We're going to buy a term policy from North American, and we're going to pay the $95 and buy the $350,000 instead of $75. And then you're going to figure out a way over the next year or so that we can start making some money. You either going to start cutting grass, you're going to start doing something. Because you only got to pay the $375 for how long? 5 years. Because you're going to get $2,000 a month at retirement. And if your wife got $2,000 and we leave her $300,000, what's 2,000 divided by 300,000? How many months is that? That's 150 months. And 150 divided by 12 is over 10 years. It's 12 years is what it is. So now she can get $2,000 for 12 years, and you don't have to worry about giving up that money. So the only thing that's gonna cost you is $375, you're still gonna get another $125 in 5 years. So now, here's the worst part. Here's the worst part. He's gonna pay me 95, right? Let's say that he don't convert it in 5 years. He's still got 15 more years of $300,000 term insurance at $95. So even if he don't give me the $395 in a year, which I know he ain't, I don't think he is. I don't say he ain't, but pretty good chance because of the way he talks to me. Okay, but at least I gave him enough money. Okay, we're talking about North American today, so I don't want to bring up another carrier right this second, but we've got another carrier that has a program that just introduced a new term product we're going to talk about next Thursday that actually allows you to not get the death benefit at one time, you get it monthly. So let's say that your house payment is $1,500. I can actually sell you a term policy that'll pay you $1,500 for the next 30 years. It's a great benefit. And see, those are the type of new ideas that we can get in front of somebody. Now see, here's the beautiful thing about that. I don't own that product, but I would like to have that product. Because what that means to me is I could go buy a policy and give it to my wife and say, hey, look, I want you to see this in black and white. If I die, it's going to pay this house payment for the next 23 years, next 25 years, next 30 years, next 20 years. So you don't have to worry about it. Yes, sir?
We've even got kits on that. I've got some here in the office on Pension Max, maximization. They've got, North American has kits on all that stuff, which I know you know, but I was just saying that for everybody else's benefit.
Yeah, and I've got all these things here. I didn't want to, I'm real bad at giving y'all so much information. When you get back to the office, by the time you get through talking to me in a month, you've got to stack this high and you'll never get through reading it. It'll be like your bathroom material. You know what I'm saying? I'm going to read this when I get time to do it, and it may not never get there. But see, here's the thing we got to think about. On the 15 and the 20-year term, males age 55 and plus and face amounts of 100, they actually can buy this product. And so when I pull these types of products up and we start asking these questions,
This is just showing hot spots on what the Advantage term will offer.
yeah, and I hope this kept my login.
Because obviously it'll go to a 30-year term.
Welcome to FEX Quotes. Whether you're an agent in the field or an IMO providing agent support, we have developed...
Hey, I don't need no commercial. What is it, Mark, 225?
Welcome to FEX Quotes.
And so now what happens is, when we start talking to our clients and we start looking...
You grow your final expense business. The heart of the system is our real-time quote engine, where we assist you in...
And so what happens is that as we start looking at people and start thinking about what they're trying to do, don't try to think you got to sell everybody permanent coverage, because when you go in there, most of the time it's going to be money purchased. And y'all have heard me use the analogy, it's like buying gas. You can pull up to the gas tank and say, give me $20 worth, or you can say, fill it up. If we got enough credit on our charge card or our debit card, we might say, fill it up, because we feel generous today. But if we don't have but $20 in our pocket, we're going to take $20 worth, because we know we ain't going to do that much driving the next 2 or 3 days. And we know we're going to get paid on Friday or something. See, everybody's got this idea, and so you got to make sure that we start looking at these type of things. Well, 90% of the people, when you start pulling out an application and you start looking at it, they may have a little bit of a health issue, but most of them are going to be able to pay their premiums, and get some kind of dollars, to help them. Now, when we come over here and look, and we run into a health issue, for an example, and we run one, and we run a 50-year-old person, and they wanted, let's say, $25,000 of coverage. These are what I call final expense products And we're not gonna get licensed with every single carrier out there. Because me and Ron has talked about this before. You know, a lot of companies, based on age, some of them do better with younger ages. And see, like, for example, if you look at Mutual of Omaha has a product that pays, a whole life product that pays 45 to 85. It does 2,000 to 40,000. And Mark, would you get me in the back there, just so I can show everybody one of these, the Term Life Express?
From the,
And the Term Life Express product that they've got will go from 25,000 to 400,000. So you can actually sell somebody in the marketplace, and when we look at that product, this is what I call a mortgage protection product. And that product, if you looked at a 30-year term, the 30-year term product on a 50-year-old will be $10.98 for a non-tobacco user. So $10.98 for 25,000. You have to forgive me. I'm a calculator guy now because I can't do nothing in my head much except what I memorized in grade school. That'd be $275 or about $30 a month. You see what I'm getting at? For 25,000. Okay, now they have to be able to answer the health questions, and so Mark's going to get the health questions to y'all, but I'm just going to sort of go over it with you real quick. The health questions are 5 questions. They just long. So the first question is, you don't have AIDS. So everybody's going to say no to that one. Do you have any artery disease, heart attack, coronary, angioplastic, stent, valve, chronic lung, COPD, bipolar, kidney disease, cancer, leukemia, lupus, organ transplant? In the past 12 months, not after 12 months, but in the past 12 months, have you required any help for bathing? Have you received any type of nursing home care? Do you use a wheelchair? In the past 12 months, have you been told you had AIDS? Have you consulted a physician for chronic cough? In the next 2 years, do you plan on being a skydiver, scuba diver, racer or anything? You would say no. Okay, if you said no to every one of those questions, you can buy from 5,000 to 400,000 with Mutual of Omaha up to age 85. Okay, now, what that means in English is that we don't have to worry about it. We can fill the app out. When it goes into the company, it's going to be guaranteed issue. We actually can fill it out over the internet. The caution I tell you about filling out over the internet is most people don't like the internet. And when you're dealing with older people especially, it scares them when they say, Lord, you going to put my social security number on the internet? Because you got to remember, you're on the computer doing it. It ain't really on the internet, but you scared them already. I want to tell you my social security number. I had a guy the other day, I said, well, how much money do you make? He said, I want you to put that on there. And I said, well, it ain't going anywhere. It's on my computer. He says, yeah, but you don't know where that'll go. So okay, let me just fill it out. Let me fill it out on the paper. You still getting that? So that's why I got to pull out a paper app. Well, see, when we look at this, y'all just heard me tell you it's $30.50, right, Earl? Did you hear me, Earl?
I'm with you. What'd you say?
Okay, I'll just see if y'all can hear me.
Yeah, we can hear you.
Okay, but see, here's the point I was getting at. With Mutual of Omaha, if you had to buy their whole life policy here, it would have been $68.08. Now, the thing that happens is, when we look at the Mutual of Omaha policy, that's why I wanted y'all to be able to see this online, because I didn't want to print all this stuff out for you. I just want to be able to show you where you can get it. From 45 to 85, you get 100% of the death benefit from $2,000 to $40,000. And so when we look at the height and weight chart, you know, the minimum weight and the maximum weight. So if we look at a 6-foot person, the maximum weight is 258. If we look at the graded death benefit is 285. So if they don't hit that rate, then you're gonna have to drop back and punt and look for another, actual carrier. So when we look at $1,000 of coverage, if we look at the monthly rate, each one of you will have a chart inside your briefcase, so you can sit there and look at it. So if we come over here and look at a 50-year-old person, then we can see $1,000 of coverage would cost $29 a month. Okay, we're pretty smart, $290 a year, excuse me. So $10,000 would have cost us $290, right? Now remember what I just showed you a while ago. Remember $30.50, they could buy that term and get it done immediately. Now, can they convert to a permanent product with Mutual of Omaha? Yes, but it's limited to the products that they have that's available for that piece. We actually can put a disability rider on this product. And I got one of them memorized so y'all can just sort of get the feeling for it. And I didn't want to focus on putting it on the board, I just wanted to be able to tell you. But with Mutual of Omaha, a 35-year-old man and a 35-year-old woman could buy a $150,000 policy for $125 a month with the disability rider that guarantees it'll be paid up, and they'll pay the premium if they become disabled, the husband or the wife. And not only that, it will actually pay a disability premium for 2 years, or whatever we pick, 4 years, whatever the disability would be. We can pick a disability benefit to pay their mortgage payment for a certain amount of time. Now, one of the things I always tell people to be cautious about is that you could buy a disability policy to pay it till you're 65 forever, but a lot of people will buy a short-term policy to do it maybe a couple of years or 3 years. Because most times if you go into a nursing home, the average stay is 4 years. If you get disabled, the average disability is not life. Most times it's 90 days to a little bit of time to recuperate. So, you know, everybody is more conscientious on looking at it from a budget standpoint. But see, so what happens is that we went over and showed them 10,000 was $290, and 25,000 was 360 bucks, you know, $30 a month, $360. So they have to pay $360 instead of $290. And they get 1.5 times the amount of insurance. But see, it don't really matter teasing somebody, because if we ask them those questions and they said yes, you see what I'm getting at? They're not going to qualify for that. So then we got to come in and start looking at some of the carriers that we've gotten and get them to decide on which products that we would actually go out and sell. But here's the part I wanted y'all to see. This is about every final expense company out there. See, when we look at Oxford Standard, it's $56. Look at the annual premium, $664. Life Shield, $729. Lafayette, $733. Colorado Banker, $707.
Hey, Terry, are you showing these on the screen?
Yeah.
Because I can't see, we're still stuck on the Advantage term hotspots. I don't know about everybody else.
Okay. Thank you for telling me that.
Yeah. We're still stuck on that screen that says 15-year and 20-year term. I see your green mouse moving there now.